Hi, my name's Jack. I'm a real estate agent and I've been doing real estate transactions here for over 10 years. And lately I've been working in Texas mostly with investors. Today we're going to be talking about the difference between tax foreclosures, mortgage foreclosures, and HOA foreclosures. So mortgage foreclosures are typically going to be done at a trustee sale. These are properties where you're buying the deal for one of the loans that's in place. It could be the first lien, it could be the second lien. And then the tax foreclosures is done with a sheriff, so somebody with a gun and a badge, and this is talking about in the state of Texas. And they're typically from judgments or taxes owed. So a lot of times you'll see in tax foreclosures that that there is no mortgage balance anymore. Usually that's the case, or if that is the case, it's because the mortgage company is going to be paying the taxes because they know taxes supersede a first loan. So if there's a first loan on the property, then they are going to want to protect their position because they'd be second under the taxes that would be owed, and they're going to use that escrow account to be paying those taxes. If for some reason a property with a mortgage gets foreclosed on for taxes, then the mortgage company would have right of redemption on that property, which would be 6 months or 2 years if it's homestead or agricultural exemption. Now a judgment works the same way as taxes. Somebody slips and falls, they get sued, and they don't have the money to come up with it. The judge says, hey, we're going to sell your property in order to satisfy that judgment. Now the other side of thing is the mortgage foreclosures. That is done with a trustee, typically on the county courthouse the first Tuesday of the month here in Texas, and that has no right of redemption. So if you buy a property, in most cases, talk with your attorney to make sure it's in your case, you are going to own that property outright at the end of that transaction. Now, if the property has something on it that will supersede your loan, like another loan or maybe taxes owed or UCC or some kind of a judgment, then that may stick to the property. So you're going to want to do your due diligence ahead of time and see what would stick to it. So UCC, which is Uniform Commercial Code, a lot of times like water heaters, stuff like that will fall into that, and that will stick with the property. Taxes will supersede, so it's like federal tax liens. As long as the IRS was notified with proper notification, those should fall off after 120 days if the IRS doesn't redeem, and I've heard that most times the IRS won't redeem. And then lastly is, so if someone took out a loan in 2009 and you're buying a loan that was taken out in 2013, unless it has a subordination clause where it's going to go under the other one, the one in 2009 would win out in its priority. And then as far as any HOA liens are a little bit funny in Texas, and most of the times they do go to the trustee sale. Those do have right of redemption, and I think it depends on if it's a condo or if it's just a homeowners association. So you're going to want to look into that more deeply, and you're probably not going to want to buy any of those unless you really know what you're doing. If you go to auction, you might see 50 people's hands go up to start bidding on a property, but then when they find out it's an HOA lien, 48 of the hands go down and 2 stay up. So only a few people really know how those work, and they're able to do pretty well. At the end of the foreclosure, there are sometimes excess proceeds. There's some people out there that do what's called chasing overages, and that's a whole business in itself where you try to get in contact with the bank or the taxing jurisdiction for the tax foreclosures and find out if there is any overage. Say they only owed $200,000 and it sold for $250,000. Well, that $50,000 go down to the homeowner. And a lot of times the bank, as I understand, is not that forthcoming with that information or that money, and so it involves some attorneys to get in the middle there and to make sure that that homeowner gets that money. And as I understand, the people who are helping the homeowner get that money get a chunk of that possibly, and that's how they're able to make very good money, from what I hear, in a business called chasing overages. So that's another business as well. So yep, if you're going to be doing the foreclosures here in Texas, probably the safest ones to buy are the first mortgage position trustee auctions. Because there's no right of redemption in most cases, you buy the property, you own it outright. It's also probably going to sell for the highest, well, it will sell for the highest out of all the other ones. Second liens sell usually much less, HOA liens and tax foreclosures and judgments as well, because of the right of redemptions and because on the second liens you're not in first position. Now, what do you do if you're in a position where there is a right of redemption? Well, a lot of times you're just going to want to sit back and wait till that time period runs out. And that means you're not going to be making repairs to the house. If, for example, you put on a brand new roof to the house and they redeem it, they don't have to give you that money for that roof in most cases. so you just bought them a new roof. However, if there's a big hole in the roof, you can protect the investment by fixing the hole. If you put on a whole new roof, they basically give you the amount of money back that it costs to fix the hole plus the interest that you'd be getting. And here in Texas, it's, in most cases in the tax foreclosures, it's 25% for the first year that you have the property and 50% in the second year. So if somebody redeems it in the second year, you're going to make what you spent on it plus reasonable expenses. That's keeping the taxes current, keeping the lawn mowed, securing the property, fixing things that need to be fixed, you know, like plumbing and stuff like that, like just to protect the property. But if you go in there and put granite countertops in and they redeem it, the judge is probably not going to give you the money for the granite countertops. Remember, you're going to be in front of a judge, probably in this case, and you're going to have to explain why you needed to make that repair in order for you to get that money back plus the interest payment on it. So if you have questions about tax foreclosures and trustee auctions, I'm probably not the best person to ask. You should probably go to your real estate attorney, just because it can get really hairy with the details, and if you make a mistake, it could cost a lot of money. And since I'm not your attorney, I'm not going to venture out there. But I do hope you learned something in this video and you can get out there and start working. A lot of people do start in the tax foreclosure world because the prices are going to be a lot less. You can secure a property for $20,000 and at least be in that position to get redeemed. Whereas with mortgage foreclosures, you're probably going to need $200,000 to at least get a decent property to start. Those are all generals. And as far as the property, you can live in it. You are the owner if there's a redemption period. So you can live in it if you wanted to, or you can rent it out. I would disclose to the tenant that this could get redeemed any day. I would only put it on a month-to-month rental, just so you know, because otherwise they could redeem it and then you might be in hot water with that tenant. All right, till next time, subscribe to my channel for more real estate tips and news.